Video lesson number 3. Thank you for joining us. Today we're going to be going over manipulation basics. The basics behind how the market is structured and why these structures or stop hunts, whipsaws, MW, wedges, and consolidation, why all those happen. So, if you're familiar with Forex and you've been in a Forex community for at least a month or more, I'm sure you've heard the term stop hunt or wow, I was stop hunted or something like that or similar. And that refers to when you are in a trade and the market suddenly spikes against you, hitting your stop loss almost like it was designed to hit your stop loss. It was like almost to the pip. And then the market completely reverses and you would have been in major profit if your stop loss would not have been hit. But that's what we are going to talk about. Stop hunts. What are they and how can you see them happening and take advantage of them? So, a stop hunt is basically one big candle or one wick or a set of railroad track candles like this one that spike out of nowhere or during news or just random volatility and hit retail traders stop losses. This is what they're designed to do. So for example, this is a larger time frame, but this happens on all time frames. So just an example is GBP USD Brexit happened, and then after Brexit there was a spike to the low out of nowhere. There was no news, nothing happened, and just a massive spike to the low that the dealer created that low here at 1.19 and then worked off of that low. You can see did not break that low and has continued upward. But a stop hunt is basically, let's say you bought right here at around here, maybe 1.22. You bought at 1.22 and placed your stop loss at 1.21. So you were in profit a bit, and then the market consolidated for a few days, and then what happened? You were stop hunted. Your stop loss that was at 1.21 was hit, just barely hit. And then the dealer came off of the low that was created there where you had your stop loss and worked off of that low, continued consolidating, spiked one more time, and then came up. So let's check out a 15-minute time frame. Here is another example of a stop hunt. Right here, this big candle out of nowhere, and we had a low set right here. You can see The candle came out, spiked below that predetermined low, spiked about 50 pips, and then reversed. You can see here as well, these are stop hunts where the level is already determined, but the dealer keeps spiking to the low to gather orders and stop people out. So let's say you saw this spike happen and you sold right here. You went negative, and then the dealer showed you a bit of profit on that stop hunt. But let's say as well, let's say there's a buyer in here as well. The buyer was showing profit. Let's say the buyer had his stop loss here. What happened? The buyer showed the seller profit and at the same time hit the stop loss of the buyer. Showed the seller profit and hit the stop loss of the buyer. And then came up and worked again in this chunk, in this area, before spiking the low once more, stop hunting, and then coming up again. So sometimes you'll see big stop hunts like this, and it all depends on the pair. The currency pair really depends on the volatility of each stop hunt. I've noticed the GBP pairs, especially GBP JPY, really have stop hunts of 30 to 50 pips sometimes is the higher stop hunt range, and Euro USD normally has stop hunts within the 20 to 30 pip range. So you can see here, these are great examples of stop hunts, these big wicks where price comes up and then closes once more, leaving that big wick and all those people trapped. So these this structure, these stop hunts really show you what's going on, what's happening. So the dealer works off of the highs and the lows. In future lessons, we will talk more about the highs and the lows, but for right now, just know that the dealer always creates a low or a high and then will work off of that low or the high, and most of the time that is when the second leg of the M or the W is created and the volatility spike happens or the stop hunt happens for the second leg of the M or the W. So, for example, here's the first leg of the M formation. We have the first leg, and then price comes down, comes back up, hits the high once more, spikes up, about 15 pips above the predetermined high, 15 or 16 pips, and then you can see it drops, and then it stop hunts one more time just to fake out anybody else that maybe caught this and sold right there. And then you can see the stop hunt happened. Grab any orders there, any pendings, activate them, and then drop once more. Also, during news events, a lot of the times you will see before a news event or during a news event, a stop hunt will occur at a higher or a low or at a second leg of an M or a W formation. And you can see that's what happened here right before the news on GBP. There was that small stop hunt to the second leg, or to the first leg, above that first leg, and then they trapped anybody in here and then dropped price on them 200 pips, and now are consolidating in this range. So that's basically the main idea of a stop hunt and why they happen. It's basically to stop people out and activate pending orders on the other side of support and resistance lines that retail traders use so often. Whipsaw. What is a whipsaw? A whipsaw is another term for basically the movement of creating a high and a low and then consolidating in the same place afterwards. We can see that happen almost every day on the 15-minute chart. It is a prime example of what happens. We can see the consolidation here. Consolidation here. Or here as well. What happened? The same thing. Right? The whipsaw. This is the whipsaw, where the dealer ends the day in consolidation, starts the new day in consolidation, fakes out low or high, and then retraces, and then retraces once more to end in consolidation to begin the next day in consolidation, where they shift the zone once more, spike the low, create the high, retrace, and then consolidate. It's the same variation, it's the same pattern, just a different variation of the pattern. And basically this whipsaw is jamming up. Its job, basically, the dealer's job, is to create a mass of liquidity in here. That's what the consolidation is, a mass of liquidity. And get all the retail traders in one zone so that he will have room to work the stop losses and hit the stop losses of both high and low. So the dealer will start the day in consolidation. London session, the dealer will spike either the high or the low. In this case, the dealer spikes the high, creates the high. What happens here? He is inducing retail traders long and at the same time stopping out short holders that are in here, this chunk of liquidity in here. Now, the dealer retraces. On this retrace, will spike to the low, hitting any retail traders stops that are in here. So, for a better representation, here is the chunk of consolidation, right? Here is the retail traders stop losses of both buyers and sellers. You can see all the dealer has to do is trap a massive sum of liquidity in consolidation for a certain period of time and then spike to the high to hit stop losses high and then spike low to hit stop losses low, and then retrace to consolidation once again to continue off the next day in consolidation to trap once more. You can see the trap, the consolidation, they spiked to the high, any stop losses in here were hit, and then retraced low and did the same thing, consolidation. And then drop, and then consolidation once more. So this is just a pattern. The whipsaw is a basic pattern that we can see happen over and over again. And news is just a continuation of this pattern. News is just induced volatility that helps create a larger macro pattern. Here we can see retail traders were trapped in here. The news, a news event, spiked high, pump, and then dump. I believe another news event spiked low. Or it may have, actually that was a flash crash. A flash crash that happened out of nowhere. It was like a 200 pip crash and or a 100 pip crash and there was no news, nothing. And the retail traders didn't know why it happened. And this is exactly why it happened. The dealer had to make up his position. He was long here. He had to get these long holders, shift the zone on them to down here to end the day in consolidation, to continue the next day, to continue the pump and dump movement. This is his structure. This is his playbook, the dealer's playbook. You can see it happening every day. Consolidation, high, low, consolidation. This is the whipsaw. This is a whipsaw. Okay? So, hopefully you understood that. That happens on every pair, no matter what pair you're looking at, and every time frame. Okay, there we go. M and W. Alright. We have discussed these before, but let's go a little bit more in depth. So the M and W is a common reversal pattern that we talked about, is also a pattern that happens in the structure of a story. We talked about that in a different, in the previous lesson. So now we'll go over some of the characteristics of the M's and the W's. Here is a great M formation, and the same can be applied to a W. So everything that I say about the M is applied to the W except inverse, right? So we've talked about this before. The dealer comes up, makes that high, and then that pre-created high, the retail traders will start to place their trend lines at this level, right? And then at that high, the dealer will work off that high, come up, and then spike to the high, and then shift down, creating that M structure. This shift, this spike to the high, has to be volatile, or in other words, it has to look like this. It has to have either a railroad track, a wick, a large wick to the high, or it has to end with a star formation like here. So we can see there was a railroad track formation, that railroad track pattern, that induced that volatility on that second leg. We can see that massive volatility and that big candle, that big wick. That wick stopped out everybody that was selling, managed to hit a lot of the stop losses of sellers right before they dumped price. Also, this spike up past, and this spike out of this above this range here, this level, the high, the dealer spiked above that high. So the retail trader, seeing that candle close above the high and then seeing that big green bar spike up, the retail trader will get emotional and buy that big bar up. And then what happens? The retail trader will get trapped in this candle wick that happens on that second leg. That second leg is designed to trap as many retail traders as possible and then dump price against them. And the same exact thing for W patterns. The same exact terminology. So we can see, again, like we talked about on GBP USD, that second leg, spike above it, and then create that candlestick wick. Right after creating that wick, price was dumped 200 pips off of that M formation. So we can see these M's and W's happening all the time in micro and in macro form. We'll go more in depth on M&W patterns and why they happen in future lessons. Alright, so next, I believe we were going to talk about wedges. Wedges and wedge breakouts. So many retail traders use or look for wedges when they're trading because this is a very easy pattern for the dealer to create, and it's a very common pattern that is created within the market. So here we can see a wedge formation right here with a breakout to the high. And how retail traders trade these wedges is they will normally trade the breakout of the wedge. That's what the retail trader is taught, and I'm sure you've heard of that before. I'm sure you've seen the graphs or the info charts of different wedges and how they break out and how you're supposed to trade them. But it's all used against us. You have to realize this. It is all used against us to take our money. It's all about the money, you guys. So, check this out. The breakout also created a second leg of this M formation right here. Price then dropped off of that M formation. You trade these patterns differently once you realize how they're being manipulated. So we know retail traders buy the breakouts of the patterns of these wedges. What does the dealer do? The dealer will break out, will show the retail trader profit, and then consolidate a bit off of that high. And sometimes, like I said, it is the second leg of an M, and then drop, shift them out of profit, and then drop once more, hitting any stop losses. This wedge is to induce retail traders and gain liquidity, trap liquidity in here. So, I also believe we were going to talk about consolidation manipulation. Right here we have another wedge. A perfect example of how it broke out, showed any retail trader's profit, and then came up and hit any stop losses of the retail traders. The next, we were talking about consolidation and consolidation manipulation. We will see chunks of consolidation like this, where price consolidates in this area and the dealer will spike to the high or to the low and then create that whipsaw off of the manipulation, or off of the consolidation, sorry. And that is the manipulation that occurs with the consolidation. the consolidation. Without consolidation, you wouldn't have that whipsaw. You wouldn't have anything to whipsaw. Alright, the dealer needs to trap liquidity. He needs to trap people in consolidation in order to work the high and then the low, and then come off of that and end the day in consolidation once more. Wow. So, thank you guys. Thank you guys for watching once more. This was lesson 3 of Manipulation Basics. Thank you for tuning in. Hope to see you in the next lesson. Peace out.